Hey everybody, it's Patrick Moore with Ironclad Wealth Management here, and today what we're going to talk about is how you can save money on your taxes when you're growing your Georgia business. Now, I've done a video series in the past on saving taxes when you sell the business, but this is very much for the business owner who's still growing, holding on to the business. It's starting to generate some cash. They're starting to get worried about that tax situation. They get hit with that big tax bill and they're like, what can I do to stop this problem while I'm still running the business? So this is going to be video one in the series that we're putting together. And the main thing that I'm going to try and accomplish in this video and just go over are the basics of paying taxes when you're a Georgia business owner, how it's different from W-2, and then what basic tax planning looks like. So that's what we're going to talk about today. Now, the big thing to remember is that this is general advice. So it's not something you need to just take, plug and play for yourself. I hope that it does apply, but you always need to consider your own individual circumstances when you're doing tax planning. Now, as I mentioned, the goal of this video is to go over the basics, but the goal of this series is to help you develop a framework for tax planning and then introduce specific strategies that you can review and analyze on your own. And these are going to basically include things like compensation planning, entity planning. Do I need to be a C-Corp, an S-Corp, an LLC, whatever that may be? What deductions are available in the state of Georgia? What credits are available in the state of Georgia? And then finally, we're going to talk about how you can integrate all of those into one plan and how you can see the benefits of looking at all of this together and how that outweighs just kind of doing one or two ideas on their own as you go. So let's dive into the basics. So the main shift that happens when you change from being a W-2 employee to a business owner is that things become unpredictable. You could have a good month, you could have a bad month, but if you're having enough good months, you will owe taxes. The questions become, how much are you paying and how often are you paying? But something that typically happens is usually when you have that first good year, you wind up with a big tax surprise in April because you're still not used to making money. You may have just had that money sitting in your business bank account, but even if it just sits in that business bank account, you're still going to owe taxes on it. And the reality is, it doesn't have to be this way. You can make what you're making and reduce and lower your taxes at the same time, and you can do it without getting surprised every April. So why do those surprises happen? Well, I think there's really two culprits when it comes to surprise tax bills. And the first is poor data. If you don't have clean books, then how can you have a sure idea of what your estimates are going to be? If you just send all of your stuff at the end of the year to your accountant and you have them guessing at what they should do, it's not going to be a situation where you're going to know what your taxes are. If you have poor data, you're making poor tax decisions. Now, the second thing that comes up, and this can happen even if you have good data, is sometimes there can be poor communication between you and your accountant, because sometimes there's a misunderstanding of what the accountant is communicating when you get your quarterly estimates from them when you file your most recent return. So if you're getting ready to file your 2025 return in April of 2026, well, the reality is that when those accountants plug those numbers in and they show you your 2026 estimates, they're just based on your return. They're not based on what's actually happening in your business. They're based on what are called the safe harbor rules. And these are better to have than nothing, but you can do better. So if you look at this, the basic safe harbor regulation, and I'm only going to deal with people who have AGI higher than $150,000. So if you're married, filing joint, or single, this applies to you. To not pay tax penalties, you have to pay 90% of what is due this year, or you have to pay 110% of the prior year's taxes to avoid those penalties. So here's an example. If in 2024 you owed $50,000, your safe harbor number would be $55,000. But let's say you actually had a little bit better of a year than projected, and you wound up owing $75,000. That would leave you with a balance due in April of $20,000, and you wouldn't owe penalties because you met the safe harbor rule. But I think it's a good example of a lack of communication. So when we're talking about basic preparation and basic paying of taxes, I think it makes more sense to judge your payments on what's actually happening each year so you don't get stuck with a big surprise. So, kind of understand what you're paying, understand these rules, and then understand that if you have good data and you have good communication, you're already kind of ahead of the pack. Now, let's go over the basics. So, the thing to understand is that payment of your taxes is due as you earn your income. So the basic quarterly dates are April, June, September, and January 15th. So for those quarters, you owe a deposit on those income or that income that you earned. Now, one little caveat that can help business owners is if you are an S-Corp or a C-Corp, your W 2 withholding is considered received ratably throughout the year. Meaning that if you make one big tax payment through your W 2 at the end of the year, it's considered basically as if it was received on like January 1st. So it's a situation where, if you're talking about trying to avoid penalties at the end of the year, your W 2 withholding can definitely help you. But otherwise, you basically just have to pay your quarterly payments on income that you're earning that's not subject to withholding, which is your business income. Now, when you're making those payments, there's two ways you can do it. You can either make four equal payments. So if you owe $100,000, 25, 25, 25, 25 with no bearing on what you're actually earning. Or what you can do is if your income has massive swings and for that $100,000, 75 of it was earned quarter one, you can use what's called the annualized income installment method, pay 75% of those taxes quarter one, and then make much smaller payments the rest of the year. A good example is accountants, right? They've got a lot of income, usually, depending on what their fee structure is, in the first 4 months of the year. That's something you can look to do if you do have uneven income. So those are the basics. That's how you get paid. The question becomes, or sorry, not how you get paid, how you pay, unfortunately. The question becomes, how do you convert those items from tax paying to tax planning? So there's really 4 steps in a tax plan. The first is you need to project your business income for the year. The second is you need to use that income to develop your estimate, which once again, like I said, as long as you're meeting your safe harbor, that's kind of what you want to base your tax payments on. Then you want to review your tax strategy to see what you can do to lower your taxes. And then you want to revise those strategies throughout the year. So step 1, as I said earlier, bad data leads to bad projections. If you can't project your business income, you're not going to be able to plan. It's probably the number one impediment I see in my practice to actually creating, we'll call them sustainable financial and tax plans. If you're unable to generate a clean P&L and kind of identify what your income is and kind of what assets you have, hire a bookkeeper. I know it sucks to have to pay an additional fee, but when you can just click a button, pull up an accurate P&L, and put it all together, it is really, really satisfying. So if you can't do it on your own, definitely maybe time to hire a bookkeeper. Now, step 2, once you've got that data, create the tax estimate. So once you have your business income, plug it into the tax planning software and create your estimate. Rather than rely on last year's safe harbor data, if you want to avoid those big surprises at the end of the year, you need to use your projections for this year. And then you need to update it and revise it as the year goes on, although I just kind of jumped ahead 2 steps. Now, you want to at least pay the safe harbor amount in case you do get surprised with like a big number. But once you've done that, there's kind of 3 ways to create your tax estimate. The first is to hire a tax planner or an accountant. The second is to utilize professional software like Holistiplan, B&A Income Tax Planner. There's others, but these are expensive enough and have enough of a learning curve that I typically recommend somebody does option 1. And then finally, you need to build an Excel, or you could build an Excel model or use an online calculator. Now, the other thing to consider and think of here is on the tax planner accountant front. I think it's important to note that just preparing tax returns is different than tax planning. Your CPA or accountant may be able to do tax planning, but you're just paying them for tax preparation and they don't have the time to devote to doing this planning for you. So if that's something you want to explore with your existing accountant, ask them, be like, hey, can we do any sort of proactive tax planning to build these estimates? Now, the third step, once you've got your tax estimate, is to review tax strategies. So every strategy is going to have pros, they're going to have cons. But when you review the numbers, if it's going to save you $20,000 in taxes, you need to update your baseline estimate and see if that makes sense, because there will be trade-offs. Every tax strategy, really, I can't even think of one too much. There might be one out there, but it's got a small trade-off. Every tax strategy has trade-offs. They're going to take more effort. They're going to take a little bit of work from you or your team. You might actually get some additional costs incurred. One of the most common one people always recommend is an S-Corp. Well, an S-Corp may work for you, but it also may reduce your Social Security tax, but your benefits when you retire. And it may add payroll costs to your firm. Another one is retirement plans. If you put money in a retirement plan, you may put it out of reach without a penalty until you reach 59 and a half. Those are some, I would say, like low risk trade offs, but there are other ones out there, and you need to consider those when you're considering tax planning strategies. And the other thing is unless you have step two, your baseline projected, there's no way you're going to actually have a good idea of if what you're saving is worth it. So make sure that you have a good baseline before you work and review strategies. And then finally, the basic one is life's going to change. You need to revise your projections throughout the year. There is a chance that strategies that looked good earlier in the year may no longer be good once you get to the end of the year. A good example is the retirement plan. If you go from expecting to have a really good year to maybe you reinvested a lot of money in the business and you're not going to make any money in the business, you don't want to deduct 401k contributions in a year that you're at the 10% tax rate, for example. So you need to make sure that you're updating and staying on top of business changes throughout the year. So once you've got that, once you've kind of got the framework, there are a few rules that we use for tax planning. The first is that the tax planning must be proactive, meaning that you can't wait until the end of the year, and you especially cannot wait until February or March to try and save money on taxes. There's just going to be less strategies available to you. You might be able to scramble and save a few, but when you're scrambling, you tend to make poor decisions. Second is that there must be a focus on lifetime tax savings, not short-term tax savings. That means that there are going to be some points in time where it makes more sense to pay the taxes now because you'll pay less taxes later. And then finally, you got to keep it legal. The last thing you want to do is incur additional significant penalties. So a quick breakdown of this is really the philosophy that governs this entire series. So when we view these strategies, we're going to talk about, okay, when do you need to do them? How do they help you? Do they have any penalties long term? And are they legal? So every time we discuss that, we're going to come back to these key three tenets. So proactive, like I said, just means you can't wait until March or February to try and save money on taxes. You might get something, but you're not going to get much. So you have to be proactive and not reactive, or you will not be able to plan effectively. The second thing is that you have to focus on lifetime tax savings. If you were in the 22% tax bracket today, and you could have a choice between not paying taxes today or paying in the future when you're at the 35% rate, you would pay $35,000 in taxes in the future. If you decided you wanted to pay taxes today, and then in the future you were at a 0% tax rate, you would only pay $22,000 in taxes. That's really right there just the choice between like a Roth IRA and a traditional IRA, just at a larger number. That's what you're choosing. If you're choosing to save today, there is a chance that you're costing yourself money in the future. And it's not always just taxes. One of the common things that's my pet peeve is people buy a big truck at the end of the year, save a lot of money on taxes, but then wind up with an asset they didn't need. They just kind of wanted it to save money on taxes, and they could have just paid the taxes, invested the money, and been in a better place long term. You have to look at the big picture when you're trying to save taxes, because you need to have an understanding of where you think your tax rate will be in the future, what it is today, and what your options are available for your money. So always focus on lifetime tax savings, not short-term tax savings. Finally, you want to keep it legal. Whenever you're reviewing a tax strategy, I want you to kind of think of three questions to ask somebody. What part of the tax code governs this? Is it written into the code, or is somebody interpreting the code? That's a big difference. Second, what incentives is the government using to kind of make this strategy allowable? Solar tax credits are a big one. Real estate investing is a big one. What is actually written into the code to incentivize this strategy? And then finally, How is the person recommending this strategy being paid? Am I paying them out of my own pocket? Are they impartial to the strategy? Or are they being paid a commission for putting me in this strategy? Usually that's something that you want to consider when you're kind of trying to review and vet a strategy being pitched to you. And finally, if your spidey senses are tingling, walk away from something before you get caught up in it. It's very hard to unwind a bad decision. So, final thoughts. This is the basic intro video. We're going to get into the details of entity planning, compensation planning, deductions, credits, and then wrapping all those into one tax plan. So I hope this kind of helps you when you think about the basics, especially the quarterly versus W-2 estimates, or sorry, quarterly estimates versus W-2 withholding, the way to think about safe harbor, poor planning, poor projections, poor communications. Those are the basics. Once you have those, then you can start looking at different strategies, and that's what we're going to do in the next set of videos. So I hope this helped, and you have a great rest of the day.